real estate investing, passively investing through certain large medium platforms that you've heard of are starting to take a hit. Home prices are changing. Are they going up? They're going down. Are builders getting back into the market or are they not? Hey guys, Matt Faircloth here from the DeRosa Group, and we are dedicated to transforming lives through real estate as a real estate company. Like this video, subscribe to this channel, and share it with a friend. Here's 3 headlines I want to talk to you guys about today. Real estate investing, passively investing through certain large medium platforms that you've heard of are starting to take a hit. Let's unpack that. Home prices are changing. Are they going up? They're going down. We're going to unpack that as well. And the real seed of the real estate market are builders, people building new homes for sale and for lease. Are builders getting back into the market or are they not? We're going to be hopping into that too. Let's get going and unpack today's news. All right, guys. So the first thing we're going to talk about is passive investing in general. There are many people that passively invest in their own deals, be that buying a duplex, triplex, something like that. But there's other people that go out there and buy deals through crowdfunding portals. Yieldstreet is one of the portals that are out there, and they're like Fundrise, that kind of thing, where large operators can go and post deals for people to invest in. Passive investors kind of use things like Yieldstreet and Fundrise as almost like a Google of real estate investing. It's very tough to get deals on those platforms, so it's perceived to be a good vetted place for the folks to go. Here's the problem. CNBC just reported that Yieldstreet investors on that platform took some of the most serious losses in real estate. Yieldstreet built this brand on giving everyday investors access to private investments. All kinds of cool things, even real estate, art, litigation, all kinds of different asset classes are on Yieldstreet. But the problem is Yieldstreet is showing major losses to those that have invested there. The reality is that some real estate bets that people put on Yieldstreet are not panning out, even with large operators that are out there. Investors are losing money, and that is a gut check for those that are looking to passively invest. Now, don't get me wrong. I'm not here to backlash Yieldstreet. I'm not talking that Yieldstreet put the wrong deals out there. I'm saying that the mighty have fallen and small deals are falling too. Real estate investing is facing a major correction right now. Even large deals with large operators on Yieldstreet are seeing it, and you're obviously, of course, seeing it on small operators as well. So here's a few quick tips if you guys are looking to passively invest on Yieldstreet or on other mediums that are out there. Number 1, how's the deal structured? Are there waterfalls? Do I, as the investor, get most of the profit in the beginning? And as the deal becomes more and more profitable, more and more profit goes towards the syndicator, the operator? That's called a waterfall. That's likely the most favorable for you, the investor. Next thing to ask is, what is the downside protection? Are there a couple of different outs in the deal that you're considering, whether that be on Yieldstreet or be that with a larger or smaller operator that you're dealing with directly? Whatever that is, what is the downside protection if the property goes down in value? Can they continue to lease it? Is there a forced exit that has to happen if the property goes down in value? Those kinds of things. So look to see what options they have for getting you out of the deal profitably. Make sure they've got at least 3, I would think. Then, above all else, what if revenue and values drop by 10 to 15%? Some say that values are going to continue to fall off. The deals are going to continue to recorrect and everything like that. So what happens if that continues? If you're looking to passively invest, or if you're an active operator and looking to put deals together, what happens if values fall? I can tell you, I was actively investing in 2008, 9, 10. I had rent coming in. It didn't matter if the deal value went way down because you could weather the storm through revenue. Rents typically don't take a crazy hiccup unless they've gone way up like this. So if you're investing in a market like Austin, Texas, or something like that, that's had a huge rent spike, you should consider a rent decline that might happen. But if you're in a market that's not experiencing huge rental increases, it's good to predict, good to think anyway, or this would be my thought, that rents are going to maintain relatively stable, maybe see a 5% drop, but that's the most that you're going to see. They could weather you through a value decrease if you've got good fixed rate debt, you've got a property that's amortizing, and you're making good revenue over time. You can weather just about any storm, as I did in 2008, 9, and 10. So that's worth considering. Bottom line, guys, crowdfunding platforms are great. They're great places to go and find and vet deals, but they're not the only place. And there's no guarantee that a deal on a crowdfunding platform like Yieldstreet or Fundrise is going to do any better than anything you find on the street. So make sure you do your own homework and consider not relying on just a crowdfunding platform to find yourself deals. Do your own homework, do your own searching around, find your own operators and talk to them directly. And for goodness sakes, if you find somebody on Yieldstreet or on Fundrise or any of those platforms and you can't talk to the sponsor direct, run the other way. You need to be able to talk to the sponsor direct to find out how your money's doing and how it's growing for you. All right, guys, next headline to talk about: home prices are finally falling. Things are starting to come back down. A lot of people predicted home prices were going to fall right when interest rates go up. But here's the problem. Interest rates change, and then real estate changes sometimes years later, because it's almost like a hand grenade. It takes time for changes in the economy and for rates to work their way through the system, okay? CBS News just reported that prices are finally falling in the most hottest real estate metros, such as Austin, Miami, Los Angeles. All of these markets are down. Some of them are down 10 to 15 to even 20%, showing in certain markets across the US. And this is a big but. Is it happening in all parts of the country? No. In a lot of other parts of the country that did not grow the way that those just cities that I just listed, and a lot of your other growth cities like Austin and Atlanta and whatnot did, if it's not those big growth cities, prices are actually staying fairly stable. So what I'm saying is the markets that spiked are seeing a decline. I remember back in 2008, 9, 10, when markets spiked and then fell off. The markets that spiked the most were the ones that fell the most. So if you're looking for great deals, consider running into the lion's den and getting into some of these markets that spiked and took off. Maybe there's somebody out there trying to unload investment property that thought that it was going to do this. They see it doing this and they're running for the hills. Maybe you can go grab a great deal in a market that spiked and markets that are solid. There's a reason why markets like Austin, Miami, Los Angeles took off. It's because they do well economically, especially Austin has enormous job growth. And if Austin real estate market is correcting, it could be a time for you to hop in and enjoy the long-term growth that Austin will see because of the continued job growth that it had. And I'll underscore one little bit more data. Markets like the Northeast and the Midwest are still seeing increases. They're up 10 to 25% from where they were just 3 years ago. Why is that? That's because it didn't spike. These markets have been slowly growing at 3 to 5% per year. And so you add it all up and they're showing 10 to 25% overall over the last 3 to 5 years. That's interesting to see. That just goes to show those markets might not spike. They're not going to go up 15, 20% a year, but they're also not going to go down by 15 to 20% a year as we're seeing now. That's also a case study. If you want slow and steady, nice cash cows, consider the Northeast, yes, I said it, the Northeast and the Midwest as a place to invest. All this stuff sums up to opportunity. That's what I'm seeing coming into the marketplace for the first time in a while. Rates are starting to creep back down, but prices are still on a interest rate hangover from over a year ago. So I think this could become a good correlation of rates that you guys can borrow money at in a favorable fashion for once and get a great deal on a piece of real estate that was priced up this way and is starting to see a decline. Markets ran up too fast. Like I said, Austin, Miami, Atlanta, Phoenix, they're starting to cool. So consider running in and checking those markets out. So if you're looking for short-term rentals, long-term rentals, single family or multifamily, now could be the time for you guys to hop in and consider today's market. The demand for rentals are continuing to go up, especially multifamily, as housing remains somewhat unaffordable for a long-time home buyer. But this could be a good time for investors to get in, while home buyers that are looking to buy houses are on the fence waiting for rates to go down to 3.5% to 4% where they just were recently. And by the way, guys, quick plug. DeRosa Group has a great tool called the Market Hunter Tool. Go to DeRosaGroup.com/tools and grab a copy of my buddy Hervé Francois' Market Hunter Tool that he created that's going to help you determine the right markets to invest in and maybe avoid the wrong markets to invest in. It is a scoring sheet that helps you determine exactly what data you want to evaluate for the markets to help determine if it's the right or the wrong market. And it'll tell you where to go to get that data. It's about as simple as it gets. So go grab our Market Hunter Tool at DeRosaGroup.com/tools. It's free. Go grab it. It'll help you pick the right market so you can exercise on the changing market we're looking at right now. Number 3, home builders that are building homes for sale and homes for lease are the absolute beginning component. They are the first domino to fall. They are creating new housing. Everybody talks about the housing gap, the housing shortage we have in America. The only way we solve that housing shortage is by building more homes. Now, this is huge, guys. Reuters just reported that home builder sentiment just dropped by 32%. That is the lowest we've seen in years. 32%. That means that they're cutting way back on their investments or resources into home building. 1/3 of them are cutting their prices. 2/3 of them are throwing incentives like free upgrades, rate buy downs, you name it, at the market. A rate buy down means if today's interest rates are 7, a builder like K. Hovnanian or D.R. Horton or large home builders or even medium-sized home builders that are right in your backyard are taking a portion of the sell price for a home and throwing it towards reducing the interest rates. You know why? Because they have to. For America to be able to afford today's housing at today's prices for rates, for interest rates, they need to throw something at these interest rates to get it down to the point where the average American can afford a house. And they can't at 6.5%, 7%. They just can't do it. So builders are feeling the pain at 32% loss in builder sentiment. Now, you're over here like, who cares? I'm a real estate investor, not a home builder. I don't care what's happening with home builders. Here's why you care. Here's why you care. People need to live somewhere. If there is a reduction in new homes being built, that is a reduce in supply. Okay. Supply is going to be down for the next couple of years. So if you get into real estate now as a passive investor or as an active investor, you're going to see increased demand for whatever product you got, as long as it's good condition product that somebody looking to buy a home would compare to a rental that they might be able to get themselves into. You're going to do well because supply is down. That means demand has to go up on the other side for rental housing, especially even if you're a fix and flipper. I'd just be careful fix and flipping right now. If you're going to do it, you got to do what the builders are doing. You got to do some rate buy downs. So if you're fixing and flipping a house and putting it on the market for sale, you might need to consider offering to buy down the interest rate for the bank loan for the end buyer might be getting for their property. Consider doing that. That's what the big boys are doing. You might have to do it too. Bottom line, guys, all this I believe is going to set up for a next rental boom. If home ownership stays unaffordable, people are going to rent for longer. That's good news for us as real estate investors if you're positioned in the right markets that are showing good economic growth. And those incentives that builders are offering, that's an opportunity for investors to partner on land or to buy projects at a discount. Maybe there's land that's owned out there that was going to be a home development for sale, and the person that owns the land's been sitting around waiting for a builder to come along. Maybe you can come along and buy that land and build a rental property on that land and be able to use it and rent it out to people that can't afford to buy a house right now, but they might be able to afford to rent your apartment while they wait for a house to build. It's a big picture here, guys. Yieldstreet reminds us, the big shall fall, the little shall fall too. Do not chase shiny objects. Vet your operators properly to make sure that you're investing in the right deals. And by the way, guys, if you guys want to vet syndicators, whoever you are, whether you meet them on Yieldstreet, meet them on other syndication platforms, or if you're a syndicator too, consider grabbing a copy of our document called 21 Questions to Ask a Syndicator. Go to DeRosaGroup.com/tools and grab a copy of 21 Questions to Ask a Syndicator. I don't care where you meet these people, Yieldstreet, on the street, CrowdStreet. Ask these syndicator questions to folks that you're considering investing in. People ask them to us all the time when they invest with us. Ask them to people that you're considering investing with. And if you're a syndicator too, make sure you can answer them properly when people come to invest with you for your next deal. Go grab it for free. Home prices are dipping. It's coming down. Maybe it's an opportunity for you guys to get in and do some rentals, or maybe even buy a halfway done development for sale that was going to go for sale. Maybe you can go in and turn those properties into for rent. Just thought of that idea. Maybe that's something you guys could do. And last thing is builder sentiment. It's painful for them, but it could set up some really good tailwinds for you as a real estate investor as things continue to change in the real estate market. Guys, bottom line, the market's not crashing. It's shifting. Right? Things are shifting, things are changing, and I believe the winds are starting to blow a little bit closer towards the benefit of real estate investors. So why not hop in to a changing market that's going to be providing more demand, lower rates, and changing markets that are perhaps changing in your favor that you guys might want to hop in on. So if you guys like what we talk about here, like I said, weekly updates on what's going on in today's economy, make sure you like this video, subscribe to this channel, and send it off to one of your other real estate buddies. I am Matt Faircloth from the DeRosa Group. Let's transform lives together, and I'll see you guys in the next video. Hey guys, one more thing. If you guys like this video, you're gonna love this other video we have here talking about tariffs. Tariffs are all over the news. You need to know how tariffs are going to affect you and your real estate investing business. Check out this video right now that'll talk about how tariffs affect real estate investors.